The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Welcome to Squawk Box Europe. I'm Karen Show with Juliana Tattelbaum. These are your headlines. Investor attention firmly on Zurich as Swiss equity markets come online this morning for the first time since Donald Trump slapped the country with one of the highest tariffs in the world at 39%.
European equity markets look to bounce back from Friday's sell-off, their steepest one-day decline since April, while investors brace for another packed earnings week and more corporate reaction to Trump's tariffs. And Friday's dire U.S. jobs report has markets pricing in a Fed rate cut at every meeting this year. Meanwhile, the White House defends President Trump's decision to fire the chief of the Bureau of Labor Statistics.
Happy Monday, everyone, as we kick off a brand new trading week. Big question this week is, are the tariffs starting to bite? And if you look at how we rounded up Friday, of course, we saw big revisions to the non-farm payroll. We saw shock in Switzerland that there's an enormous tariff coming their way, 39% when they thought it'd be much lower than that. And we've seen just bits of evidence elsewhere. The evidence from the US consumer that is starting to bite now in terms of their purchase decisions. So they're looking to trade down. We saw a bunch of earnings crossing last week that corporates, every twist and turn, they're having to deal with these border taxes. So what is the impact as the markets now turn tail?
And what is the impact for the Federal Reserve? Last time we heard from Jay Powell, he made very clear that he thought that the labor market at that point was on very solid footing. And I think Friday's jobs report, paired with what we heard from a number of corporates, puts that comment, that notion, firmly into question. In particular, the extremely large revisions that we saw to the labor market data, the fact that the unemployment rate has ticked up almost to 4.3%. That is significant here. And it has markets now firmly pricing in a rate cut in September and even spurring the debate around whether we see a 50 basis point rate cut at some point this year.
You know, all around, from very early on, we were talking about the impact of uncertainty. And we know it's exactly what the business environment doesn't want. And, you know, even this morning, we're hearing it from the Chinese. Look, we don't know what the impact of all the tariffs are going to be, or the transshipment ideas that corporates thought were a great idea to get to a China plus one strategy. That is now coming unstuck because of the transshipment tariffs that President Trump has lobbed. So I think it's the state of flux that companies have been trying to respond to and get ahead of. Now they're just sitting back waiting for the dust to settle before they come up with their finished strategy so they don't get it wrong.
Well, you bring up China, and it's a really important point that we still don't know what's going to come of the U.S.-China trade negotiations. It feels like the dust has settled now on trade negotiations around the world, with the exception, of course, of Switzerland, of Canada, which many are hoping we see a resolution between now and when the tariffs actually come into effect later this week. But we still don't know what's going to happen between Beijing and Washington. And I think that from a market perspective, that is a huge variable to bear in mind here.
Yeah, we've come a long way, because don't forget those conversations with the Chinese were in Switzerland. Switzerland also had hoped that they were going to get a fruitful deal for that country.
But my, oh my, were they wrong on that front, at least for now. Switzerland Federal Council will reportedly meet this morning after the country's National Day holiday was interrupted by the U.S. announcing tariffs of nearly 40% on its exports. Friday Business Minister Guy Parmelin said the country is open to revising its offer to the U.S. as President Karen Keller-Sutter finds herself in the center of a domestic blame game after a phone call with her U.S. counterpart late Thursday failed to avoid steep levies due to come into effect Thursday. U.S. Trade Representative Jamieson Greer told CBS the swath of tariffs President Trump imposed on countries around the world last week are set to stay in place rather than come down as a result of ongoing negotiations. Speaking in an interview that aired Sunday, Greer said a lot of these are set rates pursuant to deals. These tariff rates are pretty much set. Now, as for European futures, here's the early indication. We are looking at a modest bounce back for European equities this morning, but this comes after a steep sell-off on Friday, which saw the DAX drop 2.7%. The CAC 40 lost almost 3%. in Friday's trade. Now, we are tracking the Swiss market in particular this morning, given that the Swiss market was closed on Friday, so we didn't get a reaction there. We are going to, of course, be tracking all the moves at the open today. In terms of the Frankfurt-listed Swiss stocks, here are some of the big movers to note as investors reacted to the news. A lot of focus on the luxury sector, Richemont, swatches, given the impact that these tariffs will have on those names. We'll get you a look at those stocks in just a moment. But now let's get out to Carolyn, who joins us from Zurich. Carolyn, you were here with the early reaction on Friday. Now that we've had a few days to digest, a few days to hear from more leaders in Switzerland, what more do we know about why Switzerland ended up with this 39% tariff rate? What went wrong?
That's a very good question. Not a whole lot more is known about what exactly went wrong because the two sides were so incredibly close to a deal. Essentially, it was on the finishing line and they had agreed on a number closer to 10 to 15%, very similar to what the EU had agreed on. But there was one very important mistake that was made. They were essentially lulled into a false sense of security by the trade negotiators in the US. And they didn't understand that the final say always comes from Donald Trump. And we know how erratic the US president has been in the past. So that was the capital mistake that was made. And obviously a big shock that engulfed the Alpine nation over the weekend. Obviously, Friday was the national day. The 39%, where does that number come from? Obviously, it's pretty simple math here, very, very intuitive for Donald Trump, not so intuitive for the Swiss Alpine nation here, because the deficit with the U.S. is 39 billion. So Donald Trump pretty much took that number and translated it into a tariff rate. But as you pointed out, Juliana, there was a lot of blaming, a lot of finger pointing, a lot of soul searching here in Switzerland over the weekend, and plenty of shocked reaction from the business community. One of the most powerful business lobbies on the industrial side pointing out that tens of thousands of jobs are at risk here, saying that this is an attack on Switzerland and an industrial recession is very much likely. Another research institute pointing out that the economic impact could be quite dire, 0.3%, the hit to economic growth with pharma tariffs. Again, pharma is still excluded from that tariff rate. With pharma, the impact could be a lot more than that, closer to 0.7%. But as you rightly point out, all eyes on the market reaction in Zurich today, given that we were closed for the public holiday on Friday and spread bettors indicating a 3% fall at the open. We did see a little bit of reaction when it came to the ADRs. Richemont down more than 3%. Watches of Switzerland and London down by almost 7%. So I think it's fair to say that today is going to be a dark Monday. That said, there's still hope. There's still a little bit of time. We're 3 days away from that deadline. And in the past, we've seen these flurries of last minute deals, and that still remains a possibility, even here in Switzerland, even though the Federal Council has not confirmed that either the finance or the economy minister are set to fly to the U.S. for a last ditch attempt. But again, there's still time, but the clock is ticking.
Carolyn, it's Karen jumping in. Just when it comes to the wash up here and the recriminations, was it just bad communication from the Swiss side? Because if you look at all the exemptions, gold, the amount of gold exports transiting through Switzerland, those gold exports exempt from the reciprocal tariffs, also around what you're seeing with the pharma. This is one of the big reasons why there is that trade imbalance between the US and Switzerland. So if it's not the actual items themselves that are the issue, surely it was just a communicating error from the Swiss on this.
Again, I think all of the above, really, communication error, but also a number of grievances on the part of the U.S. President Donald Trump. Grievance when it comes to the pharma exports. And again, in terms of the U.S. exports, 60% of the Swiss exports are down to the pharma sector. And he's pledged on the campaign trail that he wants to lower healthcare costs, drug costs for the U.S. consumers by between 50 to 80%. A large part of that are, of course, the big pharma companies, two of them here in Switzerland, Roche and Novartis, of course. So he sent a letter to them on Thursday to 17 European pharma companies saying, you need to lower your drug prices within 90 90 days, or else there are going to be consequences. So this, of course, is a major grievance. It is a major sticking point, but tying that directly to the 39%, that may be a little bit far-fetched. But of course, no one knows the actual reasoning as to why Donald Trump has actually decided to go down that route of 39%. It may also have a completely different reason here. Maybe it is Switzerland's stance on Palestine. It may be the gold exports. It may be all of the above. And that is precisely the point why the Federal Council finds it so difficult to pinpoint what exactly went wrong. But now they're really doing their very best to come back potentially with a better offer. And that may actually include a spending pledge similar to what we've seen in the case of the EU or Japan.
Carolyn, thank you very much for bringing us the detail. Just a quick look at what Swatch and Richemont are doing in early hours as we chase reaction. We mentioned the closure Friday. We are expecting to see both shares fall as they open up this morning. For instance, Swatch seen down 4.9% in pre-market, along with Richemont. So roughly about 5% expected to come off both stocks. Let's get to Dr. Jörg Kramer, who is Chief Economist at Commerzbank. Thank you so much for joining us this morning. The market, economists, central bank are trying to piece together the wash-up of the tariff impact. And there is a view that, look, if we get more disruptions from the Chinese market and more cheap product into Europe, then we could see falling inflation numbers even from here. What's your view on that and just how impactful it could still be for the ECB?
Yeah, I think this is a valid point, I have to say. We know that Chinese companies, it will be very difficult for them to continue to export all the goods to the United States. And therefore, there's a lot of reports that Chinese companies do redirect their exports away from the US to the Eurozone. And this is indeed one of the arguments why we expect core inflation in the Eurozone to continue to decline a bit in coming months.
There seemed to be that, look, the ECB is pretty much done. I was talking to the IMF and they were talking about a very shallow pathway for central banks from here. But as we get into more of the detail, is it conceivable that we will see more rate cutting from the ECB?
Well, I said that the core inflation rate will continue to decline a bit. That's true, of course, but we have to see that the ECB has penciled in its own forecast a lot of decline in the overall inflation rate. They expect the overall headline inflation rate to fall to a level of 1.5% only in spring next year. That means this is already baked in. And insofar the ECB at the last meeting sent a clear signal, we already expect inflation to fall below the 2%. This is expected. And the ECB raised the bar for a further rate cut in September. And directly after the meeting, we changed our forecast. We do no longer expect a final rate cut for September after these hawkish signals by the ECB.
Jörg, we obviously have on the positive side of things the fiscal stimulus that's planned from the German government. To what extent will the positive impact there offset the negative impact from these 15% tariffs from the United States?
I have to say the 15% tariffs roughly translate into a decline in price-adjusted German exports to the United States by roughly 25%. This may lower German GDP growth by, let's say, 0.4%. That's one thing. But the fiscal stimulus is enormous. The fiscal stimulus is more than 1% of GDP, mainly because the federal government shifts the money out of the core business, out of the core budget to extra budgetary funds, which creates a lot of financial leeway in the core budget, which the government uses to increase their expenditure, primarily consumption. And this is a strong argument and a much more impact than the dampening impact from the tariffs. Therefore, I expect 1.4% GDP growth for next year.
Incredible timing from Friedrich Merz there. It's extraordinary to think about the scenario would be in if they hadn't initiated this major spending, which of course was very separate to everything that's gone on the trade front. When it comes to handling these tariffs, what is your expectation for how German corporates will respond to these higher rates in terms of absorbing the cost themselves versus passing them on to their end customers versus trying to get their foreign suppliers to absorb them?
Well, I think theory tells you that in the end it will be a mixture of all. But we know from empirical studies that in the end, let's say a 13 percentage points increase in the tariff rate will lower price adjusted exports to the US roughly by 25%. Of course, this varies from industry to industry depending on price elasticities of the customers. But in the end, all will pay for this. You can't say that this will only be paid for by the exporters. This is a very extreme solution and unlikely.
As we talk about consequences, let me ask you about the health of the US economy, because we'd long since parked conversations about the prospects of a recession from the US as we continue to see resilience. But the big revision in the non-farm payrolls numbers on Friday has some now suggesting, look, the US actually could be on course for that recession. If you look at the labor force and the sort of signals we're now getting, is there a prospect in your view that the US economy could sink into recession because of all the tariff news, which would have huge consequences for the global economy?
Sure, you're absolutely right. Well, you cannot totally rule it out. This is clear. But there are strong arguments against a recession. And look at the underlying or the trend growth of US GDP over the past couple of years. There's a lot of trend growth in the United States, underlying strength. Look at corporate earnings currently. Therefore, yes, I remain of the view that GDP growth will continue to decline, but it is unlikely to fall below the zero line. That means a recession continues not to be the most likely outcome.
And let's wrap up on Switzerland, given the shock announcement from the Trump administration at the end of last week that it would be hitting Switzerland with 39% tariffs. How do you think about the impact there on the Swiss economy and the reverberations of this, given the global nature of so many of the Swiss corporates?
Yeah, well, you said it before in your report on Switzerland. This is a huge increase in tariffs, and we already saw negative reactions from selected companies listed on non-Switzerland stock exchange. And I can only hope that there will be a last-minute deal between Switzerland and the United States.
Thank you so much for joining us this morning, Dr. Jörg Kramer, Chief Economist from Commerzbank. Let's get you a check on Swiss futures this morning. We've got an indication now, hopefully, of how the Swiss market is poised to open after being closed for the national holiday on Friday. There you have it, 2.4% lower. That's the indication at this stage. Similar to the drop we saw elsewhere in Europe on Friday, with the DAX closing 2.7% lower and the French market closing 2.9% lower. So that's the indication for Switzerland. Coming up on the show, White House officials defend President Trump's decision to fire the head of the Bureau of Labor Statistics after weak non-farm payrolls. We'll discuss more after the break. Plus, Berkshire Hathaway reports a small decline in second quarter earnings, flagging U.S. tariffs as a key headwind. More later this hour. And don't miss our interview with the CEO of Belgian metals recycling company Umicore. That's coming up at 8:30 BST.
You're looking at Swiss futures there as the market is expected to resume today after a holiday Friday. And of course, the wave of reaction to the 39% tariffs with the United States. A whole bunch of companies were seeing flashes early on how the market is anticipating they will trade. Roche and Novartis are the latest. And don't forget, both big pharma companies excluded from tariffs so far, but could face some sort of pricing regime where the United States is seeking to ensure that they do get the lowest prices for drugs internationally of some of the developed nations. So their shares in both of these two companies see down 1.6% in Julius Baer indications after these U.S. tariffs. We've just had a report that has crossed our eyes this morning from Vontobel, which has cited about 26 companies that are seen having a negative impact due to these tariffs from the States, all various different ramifications across the board. Nestle, those shares are seen down 1.6% in pre-market indications. So across the board, we're chasing that reaction for you this morning. Meantime, OPEC Plus is set to hike September oil output by 547,000 barrels per day in a full and early reversal of its largest tranche of production cuts. The group of 8 countries cited a healthy economy and low stocks behind the move. This as the US piles pressure on India to stop Russian oil purchases in a bid to get Moscow to negotiate a ceasefire deal in Ukraine. Let's take a look at the oil price this morning and see where we're traveling. You can see a slight uptick on both of those prices, about 0.1% to the upside for Brent. WTI also tracking slightly higher. But I've got to say, I filled up petrol yesterday and it was the cheapest price I've paid in many, many years.
It's amazing what an impact it has on your psyche,
the
price of petrol.
I mean, granted, I went the lowest version, not the high premium version, but it was still the lowest I've paid in a long time.
No, and it's you can see why the price of petrol, the price of gas in the U.S. is so impactful for how U.S. consumers are feeling. It really makes you feel really good or really bad. Well, speaking of really bad, we got some pretty weak jobs numbers on Friday, and also some pretty brutal news for the head of the BLS. White House officials have defended U.S. President Donald Trump's decision to fire the head of the Bureau of Labor Statistics, who he accused of being a political appointee and manipulating jobs numbers. The move came after the BLS reported non-farm payrolls growth of just 73,000 for July, missing market expectations, and revised the previous 2 months figures sharply lower, putting the 3-month growth rate at just 35,000. NBC's Kristen Welker asked White House and National Economic Advisor Kevin Hassett whether Trump is prepared to fire anyone who reports data he disagrees with.
No, absolutely not. The president wants his own people there so that when we see the numbers, they're more transparent and more reliable. And if there are big changes and big revisions, we expect more big revisions for the jobs data in September, for example, then we want to know why. We want people to explain it to us.
Following Friday's weak jobs report, expectations for a rate cut at the Fed's September meeting jumped more than 75% from 40% the day prior, according to data from the CME group. Now, Trump vowed to unveil a replacement Bureau of Labor Statistics commissioner along with a new Federal Reserve governor in the coming days. This as Governor Adriana Kugler announced on Friday she was resigning early from her term, which was due to end in January. Well, so much to discuss here, Karen. Let me kick off with the numbers themselves, which I think were much weaker than the market had expected and certainly add weight to the case for a rate cut from the Federal Reserve. And perhaps the most troubling piece here is the revisions that we've seen to the previous data. Dramatic revisions, 258,000 lower than the original figures for the previous 2 months payroll figures. That's the largest revision on record outside the pandemic, which I think just paints a different picture of how the labor market is holding up. As UBS put it, the U.S. labor market, we're seeing not hiring, not firing, real stagnation here. And we know how critical this data is for the Federal Reserve chair. And then, of course, we have the implications around the President Trump firing the head of the organization.
Yeah, to the data first up, but the cooling that we're now seeing goes to the heart of the problem. Just what sort of cooling is it, and will it take further force momentum from here? Because if you count down to September, there is a view, look, you get more revisions in September, and that will be a much bigger number. And this is due to effectively a further look at some of the data series and, why do these numbers get changed anyway? It's about accuracy, trying to improve the numbers, and you get a recalibrating of different surveys all put together from various different sources, updated methodology as well. So typically what you could see in September, revision between 550 to 950K. So those could be absolutely punishing numbers around the corner in terms of those revisions. But what does it say about the state of the labour market? And there was an indication that if you're sub 50K for a number of months, you could be on your way to recession.
Yep.
So that is well off the 150K that the Fed was targeting to suggest a more normalised economy. Now we're talking about too slow when it comes to that job creation. So there has been a wash up from the tariff side.
And ironically, with President Trump coming out and firing the head of the BLS for this weak data, it's exactly what the Fed needs to see in order to cut rates, which is what President Trump wants. So the weaker the data, the more likely that Powell will support a rate cut. When it comes to his announcement of firing the head of the BLS, this is the kind of thing that we see in places like China
Argentina.
Argentina, which makes investors doubt the integrity of the data. And if we do continue to see positive numbers come through, will investors believe it? And I just referenced China because there's always a caveat when we look at the GDP numbers that China reports. You have investors, analysts left and right saying we can't rely on this data. We know they will only allow positive data to be published. And that's sort of the route we're going down, with President Trump very publicly saying he's going to get rid of her because he doesn't like the data that she's releasing.
This is a hallmark, though, of the Trump administration. It's been to reduce the legitimacy of other sources of information, whether it's the media, whether it's the executive, and now it was talk about some of the big institutions that are gathering the data. So who does it reinforce the power of? Well, typically the US president. So it's somewhat self-serving to the point here. What is the motivation? That is to double down in terms of his own power. So I think one has to take what we're seeing with a grain of salt here. And the information we are getting from these sources, while we may not like the fact that what crosses and what we get and that there are revisions, the whole point is getting to the truth and getting to the accuracy of the information so policymakers can make suitable decisions for the economy.